Don, you sent me your question, but if you want to just ask it for the benefit of the people on here right now.
Yep. Hey Shane, thanks for doing this.
Yeah, no worries.
One off spontaneously.
Yeah.
Great idea. But yeah, this is I'm sure on every single investor's mind, probably between here and the U.S. But what's the best strategy? I guess I know it's probably dependent on market, but is it kind of best to just hang out on the sidelines for the next, let's say, 3-4 months and just watch what the market's doing, or because I'm in the GTA and
yeah,
the demand here far exceeds supply. So I don't foresee a crash ever here. I see marginal decreases. Let's just be honest with the immigration quota in Canada. I think that's everywhere. It's going to be the demand is going to far exceed supply. So I mean, there's probably going to be marginal decreases just because of certain factors playing out right now. But is it more costly to stay on the sidelines as opposed to just eating these marginal differences and just keep going full steam ahead?
Well, so thanks for asking. It sounds like you've kind of made up your mind a little bit, right? In terms of just hearing you ask the question was like, I'm paraphrasing, but you don't see the market going down, right? And so if that's a belief system that you have, then if you buy today, in the future, it's going to continue to rise. Now, I'm not saying I agree or disagree with that, but I think really what it comes down to is, first, it's a hard question because I think people are going to have different investing strategies, right? So my strategy is value add or development, right? So I'm always finding properties that I can really kind of push the value on. Certainly what's going on today is making it a little bit more challenging, right? When I go out and get quotes for construction, they change very frequently, right? So the townhouse project that we're doing, I've got a retail development that's gone up probably 20% since I want to say November, when we first put it under contract and signed the leases. I can't just unplug these deals. You know what I mean? Like, I've got a lot of money and effort and energy put into them. And I would say on the residential side, there's a little more flexibility in terms of being able to push the rates, right? So as interest rates go up, generally speaking, it becomes more difficult for people to afford houses, right? And so you'll see more renters, right? This is at least in my experience. So on the flip side, though, on say a retail development where we're locking in our rates, I can tell you that I'm more sensitive to that because my costs are going up, but my rates are going to be fixed for the next foreseeable future, right? So there's different strategies you can kind of use on some of these kind of value add or construction projects. But for me, I'm looking at it saying, as long as I'm investing in properties that I believe for the long term, like I'm not flipping, right? The shortest term deal I have is probably 2 to 5 years, right? And some of these are 10 years plus. And so for me, I'm okay. I'm not trying to time the market because I have no idea where interest rates are going to go, right? They might go up, they might come back down, they might stay flat. And if I was to try to base my investing on things that are outside of my control, it would be very frustrating, right? So I have to kind of have a certain strategy and beliefs and then conviction, if you will, and then act on those. I could be wrong, right? I mean, there's some very successful people that have lost money and made mistakes, if you will. But this is just how I'm looking at the market, saying, you know what, I'm not trying to time it. I'm not going to jump in and out because some of these deals take 6 months, right? So if I'm constantly going in and out because the Bank of Canada is raising rates by 50 bips or 75, I mean, I won't go anywhere, right? And then investors lose confidence. So I have to plan for it. I have to have sensitivity and I have to have much larger contingencies. But that's just how I'm looking at it. So I don't know if that's helpful or not, but, and you know, it's not to say that you have to invest in the GTA. Obviously you believe in that market. It's done very well. And if you think it's continue to rise over the future, I mean, A, you don't have to invest today. You could certainly sit on the sidelines and see what happens, right? Like why would you, I guess, what would be one of the reasons to stay on the sidelines from your perspective?
Again, just to see if there's these marginal dips that, or even just supply. I mean, I think that there's, you can already see it. The supply is already increasing.
Right.
So, you don't want to have fear of missing out at this point. It's kind of maybe hang out and kind of watch and see what does come up. And then you can start jumping on maybe better opportunities that are here now than they wouldn't have been otherwise.
Yeah. So I'm curious because different asset classes are going to have different opportunities too, right? And so what asset classes are you looking at? Just so I have some context.
Yeah. So looking at just that multifamily residential.
Okay. And how big?
I would say above a 10.
10 units?
Yeah.
Yeah.
And
Okay.
between 10, let's say between 10 and, let's say 10 and 20.
Okay. Yeah. So that you're right. Like that market there is hyper competitive, right? There's a lot of investors. Oh, shoot. Sorry. Said my internet was unstable. And here are some of the questions that I fielded earlier. And I just really want to make sure that I go through them one more time for the benefit of those that asked the questions. And then obviously, if you weren't on, then you can listen in right now. So Don asked, his question paraphrased was, should I be sitting on the sidelines to wait and see what the market does, or should I constantly be investing? And Don is in the GTA or the Toronto area. And inside of his question, when he asked it, he made the comment that he doesn't see the demand for real estate, specifically multifamily or rental, going down anytime soon, especially with immigration and just the strong demand. And so he asked whether or not he should be sitting on the sidelines. And my answer, just for the lawyers and accountants out there, none of this is investing advice. So just take it as just one guy's thoughts as it relates to investing in commercial real estate. So what I told Don is, I said, first of all, I think a big part of this really kind of comes down to what your strategy is. For me, I never try to time the market. I think that is kind of very difficult, even for the best investors out there. And so for me, I will change my strategies based on what I'm seeing and where I think the market is headed. But I don't try to quote unquote time the market, get in, get out. And the reason for that is, I mean, some of my projects have been kind of 6 months in the making. And so, if I was trying to time the market, interest rates have gone up probably a point to a point and a quarter since I put my one multifamily project under contract, as well as a retail development. And so it really isn't realistic, especially when you're doing projects that might take 2 or 3 years to complete, to try to come in and out of the market. So for me, I think what's more important is to say, like, do you believe in the location, the city that you're investing in? What is your strategy, right? For me, always value add or development for that matter. And so I would say that in these more kind of uncertain times, I just have much bigger bandwidth in terms of sensitivity analysis, right? So when I'm underwriting a property, I'm going to push interest rates higher. I'm going to push my costs much higher than they would have before. And I'm really going to test and see, does this deal still pencil out if these negative things, right? Costs go up by X percent, 10%, 15%, 20%. Interest rates go up by 1%, 2%. Vacancies, whether they go up or rent growth doesn't happen as much as I think it's going to. So that's really how I would answer that question. Now, Werner asked the question about new construction, and his question was, how long is it for a typical exit? And I said, this is just me personally, and every investor is going to have their own ways of looking at these projects. I usually have a plan A and a plan B. And plan A is generally to hold these assets, especially given how hard it is to develop and how long it takes and how much effort goes into it. So I'm always happy to hold. But if someone comes along and makes me an offer that makes a lot of sense to me, then I will sell, right? One of my kind of guiding principles is I don't fall in love with my real estate. And so that's kind of how I look at it. If I hold, yes, I will either look at refinancing. It just depends on how much leverage I got on the construction side. Okay. And what is the timeline from kind of when I break ground to when the property is stabilized? I would say generally it's about 18 to 24 months. However, this retail project that we have right now took almost 3 years for us to complete. Obviously, dealing with COVID didn't do us any favors, but it's worked out to be a very good, retail development, and it just took longer than we expected. Okay, Payush asked. Interest rates and cap rates. I think essentially what he's getting at is, it's hard to make sense of the cap rates with interest rates going up. And, this is definitely something that investors are looking at. And I think it's always important to look at things a couple different ways. And why I say that is a cap rate is really just like a snapshot in time. And so let's just say, just if you don't know what a cap rate is, if you bought a property all cash, what would be the return on that, on your investment if you paid all cash, right? So if you bought a $100,000 property and it was paying you $5,000 a year, that would be a 5 cap, right? So what I would say is, for me anyways, I'm usually looking at value add and development. So for me, cap rates are less important. What I would also suggest is that none of this happens in a vacuum. And what I mean by that is I'm watching some very smart people right now talking about industrial and retail, obviously multifamily as well, where they expect growth in all rents, excuse me, in the rental rates of those asset classes. Those are the three that I pay attention to. I'm sure that they're happening in self-storage and office and whatnot. But if you just look at inflation and how it is driving the cost structure up on any new developer, right? So we have 3 projects on the go right now. I can tell you from just 6 months ago, we're up 20%. From 2 years ago, it's probably 35 to 40%. And so if you are building a new retail project or if you're building a new multifamily today, it won't make sense unless the rental rates are high enough to justify these new cost structures. So one of a few things will either happen. Developers will go away. They'll stop developing because it doesn't make sense. In which case, the existing assets are going to have more pressure, more upwards pressure, because as long as demand continues to rise and supply either remains constant or decreases, then obviously your prices are going to go up. And if you obviously are in markets that are growing and you've got that pent up demand, if you will, it's just going to push rental rates to continue to climb. And so that's my philosophy. Am I right? I have no idea, right? But that is kind of where my head is at right now. There was another question as it surrounds kind of inflation. I think I talked a little bit about that. I think his question, I don't have it right in front of me. Okay, I'm going to continue. The second question was, will people leave real estate as an investment class and because interest rates are going up? And I said, some people probably will, right? I think there's more people today that are looking at real estate as a hedge against inflation, right? They want to own tangible hard assets in inflationary times. I mean, you just think of buying a vehicle. No one would have thought that was a good investment. And I'm not saying it is a good investment, but I bought a truck, I don't know, 6 months ago, and it's worth more today than it was 6 months ago, right? Like I could sell it for $10,000 to $15,000 more, which doesn't really make any sense. So, so yes, I believe some people might exit real estate, but I think more people are going to come into real estate because they're looking for that tangible hard asset. And I think that you're going to see rent growth continue. And his last question was, with construction costs increasing, is value add a good option? I think value add is always a really good option. For me, it's just been, I have a competitive advantage, and so I like construction, but it's not to say that I won't do value add. I frankly, value add has far less risk, and if you do it right, probably has higher upside. It just so happens that I've got very good relationships with owners of land as well as tenants, and it doesn't make. Oftentimes, they come to us and they say we want to be here, and there just isn't an option. And so that is really why we focus on new construction. But I'm all for doing value add, and so I think that there's always a place for that. I will say what I'm seeing more and more, and just my own investing philosophy as it changes over time, is that I'm not as interested in doing older kind of call it C product, even B minus on the multifamily side for my own personal reasons. And so for me, I much rather have newer, shiny product that attracts different clientele. So, not saying it's right, not saying it's wrong. Everyone has their own strategy. That's just mine. So